Hi, this is estate planning lawyer Michael Pevney, and in this video we're going to talk about what happens to your 401k and other retirement accounts after you pass away. But before that, if you are interested in estate planning, please subscribe to this channel and ask a question in the comment section. I'm usually able to respond to each and every one of them. So first, it's very likely that through your job you have a retirement account like a 401k. Some public employees have a 457b, and you might create a retirement account on your own, like an IRA, Roth IRA, or something else like that, even SEP IRAs and things like that. So when it comes to 401ks, and you pass away, that 401k is going to be inherited by whoever that beneficiary is. Now, specifically with certain retirement plans, if you are married, the default person, and in fact, it is required to go to your spouse. There are special rules and there's federal laws written about this, unless your spouse signs off on having the beneficiary be somebody else. Now, one thing that's great about retirement accounts is that it passes without having to go through probate, because probate, especially in California where I practice, is a very long, drawn out process that can take several years, and it's very expensive. But if you have no beneficiary and you're not married, yes, and it just goes to your estate, yes, that retirement account is going to have to go through probate, which is a big pain. But the default is if you're married, it's going to end up going probate-free to your spouse. Now, for people that aren't necessarily married but do have a beneficiary on there, it is going to go to that beneficiary, whoever is listed on that account. And this is something that we have to revisit, and I've got to talk to my clients about a lot, because oftentimes somebody might have put maybe a parent, maybe they were in their young 20s and not married or didn't have kids yet, maybe they've gone through a marriage and a divorce, and they didn't have things set up the way they would necessarily want to now. And back when they initially started this job and initially started working for this company or government agency, they had their parents or maybe even a sibling set up as the beneficiary for a 401k. And since then, maybe they've gotten married, maybe they've had kids, maybe they got married and divorced, maybe they have a significant other that they're not necessarily married to, and they wouldn't want that account going to anybody else other than them. So in that case, it's very important, because a 401k doesn't go through the probate process and you don't really distribute it through a will or a trust. The company that holds that money, the 401k, is going to give that money to whoever is listed on that beneficiary account. So even though you might have a significant other that you're engaged to, or you've been married and divorced and have kids, and you want that money to go to the kids, it's going to go to whoever that beneficiary is. And if that beneficiary is no longer alive, then it's going to go through your estate, meaning it has to go through the probate process, and that can cause a huge mess. Now, in some circumstances, for most of my clients, I recommend setting up a trust, specifically a revocable living trust. I practice in California. Anything that goes through probate is a huge pain, and we want to avoid that at all costs if possible. And in some situations, we actually want to make the trust the beneficiary of some of these retirement accounts. Now, there are some tax consequences to that, because in trusts, income from trusts are taxed very high, and in most traditional retirement accounts, unless it's a Roth, none of this money has ever been taxed, and the government wants to get their hands on it. Now, there are certain ways to have the income and the distributions flow through that trust and end up being taxed at the individual's rate. We're getting a little bit into the weeds here, but in some circumstances, it might be appropriate to make a trust either the primary, if not the alternate beneficiary of those retirement accounts. So when it comes to retirement accounts, it is going to go to whoever the beneficiary is. Unless you're married, it's required to go to the spouse, unless they sign off on it. Be very careful that that stuff doesn't have to go through probate, and be very careful and make sure that those beneficiaries are updated if you go through any life changes, especially like a marriage or a divorce, or there's a birth, or there's a death. If you are interested in this or anything else related to estate planning and you live in California, you can set up a time to meet with me for free by going to ocestateplanlawyer.com. Thanks for watching.